Good morning, this is Larry Edelson for my Uncommon Wisdom video for Thursday, May 20th. Quite interesting markets again this week, dominated largely by the European sovereign debt crisis, which will come and go, but it is here for quite some time, and it will leap across the Atlantic Ocean to the United States. Probably, my guess, based on my work, by the end of this year. This is a very, very serious crisis. It is undoubtedly many times larger than even the mortgage subprime real estate crisis. It is undoubtedly, in terms of size and scope, even larger than the sovereign debt crisis we saw during the Great Depression. However, as I've noted in past videos and in my writings, this time around, unlike the Great Depression, it's going to be very, very different because the world has a different monetary system today than it had in the 1930s. We no longer have a gold standard. We have free-floating currencies, we have fiat currencies, so naturally one cannot expect the same results, a massive deflationary depression like we saw in the 30s. It's going to be very different and very deceiving. Let's go right to the markets right now. I want to take a look at gold. It's up here on my screen. This is the chart action I've been following all along for the last several months with you. We did run up to new record highs earlier this week, right up here at the 1249, 1250 level, just above this uptrend line here. Gold is now pulling back down. It's going to find support just under 1200, 1180, maybe 1165 worst case, and then begin to rally anew. All pullbacks in gold now should be viewed as buying opportunities. A couple weeks ago we got that massive buy signal that I reported to you, which was a close above 1162. That to me indicates all pullbacks should be bought, and the gold is going to move to one new record high after another. It will not be a straight up affair. There will be zigs and zags along the way, but gold is your barometer here for this sovereign debt crisis. It is the only currency that is gaining in value, while all other fiat currencies are basically losing purchasing power, even the dollar. What gold's rally to new record highs this week, along with a rally in the dollar, is telling you is that yes, the euro is collapsing, but the dollar is also losing purchasing power against gold. And if you can think this through for a minute, you'll see how dynamic this is. If the dollar, if gold can rally to new record highs with a temporary rally in the dollar, imagine how much higher gold can go when the sovereign debt crisis hits the United States and starts pounding the US dollar like it's been pounding the euro. Keep that in mind, very, very significant. Gold is telling you here that it is the only real currency in the world right now, and that you have bear markets essentially in the purchasing power of the world's two major fiat currencies, the euro and the dollar. Let's take a look now at stocks. We had, of course, that flash crash last week, and since then we've recovered up to test resistance at just about 11, and we've fallen back down to 10.4, 10.5. As I noted previously, this is not the time to be heavy owners of stocks here, except for gold shares and some key natural resource stocks. We are now back in a bear market in the Dow. We will likely see the Dow fall to about 9,200 on this move. It's a short-term bear market. We are not going to see a crash to below the March 2009 lows at 6,500. I don't believe that's going to happen. I do believe we'll get down to 9, maybe pierce below 9,000. But then eventually, when the debt crisis hits the US dollar, we are going to see stocks reinflate to the upside. This is the exact opposite of what happened in the 30s. However, keep in mind, as I mentioned earlier, we have exactly the opposite monetary system that we had in the 30s. So logically, that makes pretty good common sense that we'll see stocks inflate higher. We've seen that occur in all third world countries that have had a sovereign debt and currency crisis. There's no reason not to expect that would happen in the first world, where we are now having a first world debt and currency crisis. But don't jump in and buy stocks based on that. Wait for my signals. We're going to see quite a sharp pullback between now and then, and quite a lot of volatility and chaos before stocks start to inflate higher. Let's take a look at another market right now, oil. Oil's had a steep 20% sell-off in about a week or so, a couple of weeks, which has even surprised me. However, if you take a look at oil now, you see these two cyclical support lines which extend back in time beyond what this chart shows here, but they're very solid support levels at 71 and 69 and change for oil. So I am looking for a bottom here in oil and then a move back up to at least 80, probably some sideways action then, and then a breakout early next year or latter part of this year, up and to new highs, 92, 96, and then $100 a barrel and higher. So stay alert to my publications. I will be looking to add energy shares very shortly here at this support level. Cycles do point higher for oil. Let's take a look at the dollar now. This is the same chart I've been showing you. As you can tell, this is the spike high here in the dollar that's occurred as the euro has collapsed. However, this cyclical resistance line here, this upper trend channel, which is based on a cyclical model, you can see that the dollar index is starting to hit resistance here. Dollar has two choices here. It either starts to run out of steam on this rally and the euro starts to bounce and the dollar index pulls back to 85, or we could see an explosion higher, even higher in the dollar. We're at a critical turning point here, so keep your eyes on the dollar, and I'm going to be watching it very closely as well. That's it for today. Have a good weekend. Please stay tuned to my Uncommon Wisdom Monday column, to my Real Wealth Report if you're a subscriber. This month's May edition will be going to press today and will be hitting the web on Friday. You'll definitely want to read that if you're a subscriber. If you're not a subscriber, I would certainly consider taking out a subscription to it. And if you're one of my members to my trading services, stay alert for a lot of upcoming recommendations. Till next week, this is Larry.